corporate tax is a very complex, significantly more complex than value-added tax, which was introduced previously. UAE was never a tax haven. UAE didn't have to implement corporate tax. It could have chosen not to. But historically, the UAE was blacklisted by the EU.
In January last year, the UAE government announced the introduction of the corporate tax with a standard rate of 9%, but confirmed last week that it would only apply to firms making more than 1 million dirhams in revenue. The tax will come into effect in the beginning of next month for companies with a financial year starting in June. And for those that follow the calendar year as its financial year, the corporate tax will be applicable from 2024. Would this move help Dubai escape from being branded as a tax haven? Head of tax at Tamimi Company, Shiraz Khan, explains.
UAE was never a tax haven. Of course, a tax haven is a place where companies and businesses come and they set up. They don't have any rail operations and they're just established in that jurisdiction purely to shift the profits in that country and not pay any tax. The UAE is, of course, a global financial center. It's also a regional operating hub and, as a holding company region. But historically, the UAE was blacklisted by the EU. And the reason was because, they can't force the UAE to have a corporate tax. However, they were trying to ensure that the UAE is not used as a jurisdiction where companies artificially shift profits. Having a corporate tax will help the fact that the UAE cannot be used as a jurisdiction to move profits to, because there's no tax here.
Since its implementation in 2018, value-added tax has generated over $26 billion for the UAE. While corporate tax is also expected to be another important source of revenue for the country, diversifying away from its reliance on hydrocarbons, the reason why it is being introduced right now has a lot to do with the developments happening at a global level. The OECD introduced the global minimum corporate tax of 15% for companies with revenues over 750 million euros to discourage tax-motivated profit shifting and tax avoidance by MNCs. So the UAE was basically faced with the choice of either taxing such companies here or foregoing the tax income to another country.
UAE didn't have to implement corporate tax. It could have chosen not to. But the consequence of not implementing corporate tax would have meant that UAE companies which have historically been operating here are not being subjected to tax. And because the UAE has not introduced a corporate tax, some of these companies, the multinational companies, which are operating in multiple jurisdictions and have global consolidated revenue of 750 million euros, it would mean, although they're operating in the UAE and the UAE is not taxing them, other countries are taxing them on profits they're generating in the UAE. Then of course the UAE is losing out. That's one of the main reasons why corporate tax was introduced.